A very good afternoon. Welcome back after a long weekend. I mean, we had Monday as an off. So I hope all of us are back with full energy. And today we're going to complete the fourth chapter and maybe even do quite a lot of the fifth chapter as well. So Anjana, Osama, Arisha, Janvi, you're all here. And idea is to complete the fourth chapter. This is what we want to do basically. Uh, I'm good, Osama. Hope you're doing well also. Now, what we will do is, again, I'm just going to go do a recap. This is technically our fourth or fifth class. This is what we covered in the first class. This was done. Okay. Then these topics were done on the 24th of March. Then on the 26th, this is what we did. And on the 28th, we didn't do much because on the 26th, we did advanced and delayed annuities and perpetuities in a lot more detail. Okay, so today, which is the 2nd of April, today we're going to complete the fourth chapter. 2nd of April, 2025. Okay, now before I start, today, the first 10 minutes, I will not ask questions, but I'm going to introduce you to something and make some important announcements. That's what I'm going to do today. In the first 10 minutes, it's 2:02 right now, Indian time. Now, again, in order to enhance our overall experience, overall how the classes are, we have quite a lot of features now added. I don't know if I mentioned this, but now every day we will take an attendance, number one. This attendance is captured. If you're doing live, it gets captured by me. But if you're watching the recording, then it automatically gets captured by the LMS itself, where we can see when did you last access, which class did you attend, which video did you watch, for how long did you watch, how many times did you watch. All of that will definitely be there. Okay. So this is obviously as part of our continuous efforts to make the overall journey and overall experience good for you. And that is the first change we've brought in. And Jigyasa. All of these people are present. Anybody else? Nitesh and Prachi. Sorry. Nitesh and Prachi. So all of these people are present. Okay. Apart from that, the next thing that we have brought in to overall improvise on what you experience from us is weekly tests every Friday. I don't know if I've mentioned this, but every Friday we will upload a test on the LMS. This test will include the textbook questions. It will include the Kaplan kit questions. It will include the BPP kit questions. It will include the study hub practice questions also. Meaning that you have to start the kits from now itself, not after the syllabus is over. By mid-May, I want you to be done with the textbook, with the Kaplan kit, you're done with the BPP kit, you're done with the study hub practice questions, you're done with the articles, you're done with even the flashcards, you're done with the examiner's report. Everything should be complete. Last 2 weeks should only be like a revision. Right? So every Friday there will be a test. And in order to support you for these tests, apart from our class that happens every week, thrice a week, apart from that, we will also be uploading videos where we solve exam kit questions, which you can watch anytime. So apart from the class you have to either watch as a recording or you attend the live class. But apart from that, you will also be given access to. No, most of them only tell you to complete Kaplan kit. No, that's what we don't believe in that. We believe that you before you go for the exam, you should be completely thorough with everything. And again, we will upload a few Kaplan kit solving questions. We will upload a few questions where we are solving the PPP kit. We will upload a few questions where we are solving the study hub practice questions. So you get a variety of practice. Few questions we will practice, so you get the hang of it. And few questions that are hard for you, you can tell us, we will upload that. But apart from that, the other questions you have to practice, and you start practicing from Kaplan, BPP, study hub practice questions from now itself, not after the syllabus is over. Yes, we will cover all the tests, Kaplan, BPP, study hub, everything we will cover. Okay, so you have to attend the classes, study the textbook. Once you've attended the classes and studied the textbook, watch the recordings where we are solving kit questions. Once that is done, you need to be ready for the test on Friday. And the Friday test, every Friday, it will cover what? As I said, it will cover everything until whatever is done in class. So, for example, today I will finish the fourth chapter and maybe I will start the fifth chapter. So you will have a test for all these five chapters from the textbook, Kaplan Kit, PPP Kit, Study Hub practice questions, everywhere. You will have a test on these five chapters. So you don't need to ask me what's the syllabus. Until Friday, whatever is over, everything is asked. So we know, nobody needs to ask anybody. Until whatever is done, you will be examined on that. Now, we do understand that we have a lot of working professionals also studying with us. So, in order to accommodate and in order to make sure that we are kind of taking care of them also, what I have decided to do is the Friday test will be open till Monday morning, 11 a.m. All timings are IST, Indian Standard Time. So, the Friday test you can access until Monday morning, 11 a.m. So, you have Friday, Saturday, Sunday, and even Monday morning. Till Monday morning, you have time. Okay. After that, the test will automatically disappear. So the reason we have it until Monday morning is so that the ones who did not attend, or say the ones who did not have time on Friday because they are a working professional, maybe they'll find on time on Saturday. Or again, if they don't find time on Saturday also, at least Sunday they will be there. As I said, Nitish, all chapters until whatever I have completed till Friday will be tested on Friday. Okay, so this coming Friday, most likely we will have a test on five chapters, and I will get a notification like this. As soon as you submit the test, so our LMS is decently sophisticated, meaning as soon as you complete the test, I will get a notification, the instructor will get a notification where I can see everything. When did you start the test? When did you complete the test? How much time did you take overall? When did you submit it? Overall, she has taken 11 minutes and she has scored 5 out of 5. And I can also individually see the answers. Right? Similarly, as I said, even the recordings that are uploaded, we can see everything. We can see who all have watched with your name, for how long did you watch, how many times did you watch. So the team, Babu, he does a very good job in keeping a close track. And also, he's always there to answer your queries on the hotline number. It is 2:11 now. Speed accelerator on LMS. Yes, we are working on that. We will soon have that enabled. Okay, so today's class is what? First of all, I wanted to quickly recap on real return, test your understanding one and two, because they're very, very easy. Look, this chapter, what is it saying? I'm just going to quickly recap on 28th of March's class. Okay, when you invest money, you want a return. Say when you invest, for example, you invest 10,000 on ACCA. But through ACCA, when you find a job, what do you want? You want a return. The real return that, I mean, you've invested 10,000, so obviously you want a return. So tomorrow, when you get a salary, you want a salary of more than 10,000. You want maybe 14,000. No, this is your imagination. US dollars, pounds, completely your imagination. But this return that you expect is what any investor would also expect. This return is known as the real return. That is the return that we expect because of the investment. Real return is the investment, the return that you expect because you invested money. However, there is also another element involved. Yes, you want a return of 14,000, meaning a total, you want a net benefit of 4,000. 10,000 you invested, you're getting back 14,000, so you want back 4,000. But remember, there is what? There is inflation. I mentioned what inflation is. Inflation is basically rise in price. Tomorrow, when you get 14,000 and when you go out shopping, you will see that in 14,000, you will not be able to buy much. So you also want a return to cover that inflation. You also want a return that will take care of that inflation. The return expected on top of the real return. Yes, you want the real return, correct? I agree. But on top of that, in addition to that, on top of or in addition to the real return, the return expected in addition to the real return, in order to cover for the inflation or rising prices, that return that you expect is known as what return? That return that you expect is related to inflation. You want, see, one is you want your money to come back. You want your money to earn something. That is the real return. You want some money to return back to you. You want to make money. But apart from that, apart from what you want to make, you need to make sure that we also have a return that is covering or taking care of the inflation, paying for the inflation. That return is known as, again, we're talking about this return is the return that is needed to compensate for the inflation. The overall return that we expect is called the money or the nominal rate of return, and the formula was this. The total return we need is the real return plus the return for inflation. Sorry, multiplied into the return for inflation. What is written after in order to cover for the inflation, rising prices. So the total return we will expect is you need money to, the total return is the return that we earn. But other than that, you also want the return that will take care of inflation. Now, again, if I have to get a little deeper into that, let's just assume that you people are starting a business. Okay, and you reach out to me to invest in your business. You ask me for money, you ask me for 10 lakh rupees. Now, I will not give this 10 lakh rupees for free, correct? I want what? In my mind, I will say, if I give this 10 lakhs, I want to make back 12 lakhs. So that is the first return you want. If I invest 10 lakhs, I want to earn back 12 lakhs. I want a good return to take care of my return on your money is what you want back. Yes, I want return on my money. I want to earn back more money. This return is the real return. I want real money back. Okay, fine. You agree to repay me 12 lakhs. I'm putting this in red. You agree to repay me 12 lakhs. I am happy I'm getting a real return. Yes. But when you give me 12 lakhs after 3 years, that's the problem. You are giving me 12 lakhs after 3 years. And when I take 12 lakhs to a shop after 3 years, there is a problem. What is the problem? The problem is, oh, all the prices have increased. You are giving me 12 lakhs after 3 years, but the problem is what? The problem is after 3 years, when I go to the shop, all the prices are very expensive. So now I come back to you and I say, I'm just imagining, oh, after 3 years, when I go to the mall, everything will be very expensive. So I say, okay, I want this 12 lakhs. But in addition to this real return, which is 12 lakhs, I also want a return. In addition to the real return, I want a return that will pay for inflation after 3 years and number of years. That return is the return for inflation or the compensation for inflation. So basically, you want two things. You want real return plus you want the compensation for inflation. And that's why the total what you want is real return plus the compensation for inflation. And that's why the total of what you want is known as what? It is known as the money rate of return. The overall money that you want, money rate of return is the total money you want. You want the real return plus the compensation for the inflation. So the total money you want is the money rate of return. And that's why the formula is 1 plus I is equal to 1 plus R into 1 plus H, where H is inflation, R is the real rate. Okay, and I is the money rate. So this is something we saw in the last class. For example, test your understanding one. 1,000 is invested in an account that pays 10% interest per year. Inflation is currently 7% per year. Find the real rate on the investment. Don't worry, I'll only do test your understanding one. Test your understanding two, I'll not do. I'm just quickly recapping on everything. So, what is happening? Inflation is, H is how much? Inflation is 7%. Find the real return on the investment. Again, you want what? You want the real return on the investment. You want R. So the formula was 1 plus, look at this, 1 plus I is equal to 1 plus R into 1 plus H. You want the value of R. So you simply substitute, right? I is what? The money rate. Is it given? Remember, money rate is what? You are getting 10% every year, and inflation is 7%. So the real rate will be, again, this is what you need. So it's a simple grade 5 maths. If you need this, simply send 1 plus h to the left hand side. And if it goes to the left hand side, the sign will change. On the LHS, it is being what? It is being multiplied. So if it goes on one side, on the RHS, it is being multiplied. So if it goes to the LHS, it will get divided. So the formula will simply become 1 plus I divided by 1 plus h is equal to 1 plus r. 1 plus I divided by 1 plus h is equal to 1 plus r. So 1 plus I is 1 plus I. I is how much? 10%. So 1 plus 10% will be how much? 1.1 divided by h. Inflation is 7%, 1.07. 1 plus 7% is 1.07. So 1.1 divided by 1.07 will be 1.02. 1.028. So you see 1 plus r is equal to 1.028. So 1 plus r is equal to 1.028. Therefore, r is equal to, again, simple maths now. Send the 1 to the RHS. 1.028 minus 1 is equal to 0.28. So r is equal to 28%. Sorry, not 28%, 2.8%. 1.028 will be 0.028. So r is equal to 0.028 into 100% will be 2.8%. This is what we did in the last class. Yes, Nitish, that's absolutely right. So guys, with that, we are now finally going to start the class for today, and that is going to be something very, very, very interesting. Today's class and today's topic is going to be very interesting. Yes, that's absolutely right, Nitish. See, Stormco is evaluating Project X, which requires an initial investment of 50,000. Expected net cash flows are 20,000 per year for 4 years. Okay, that's very good. At today's prices. However, these are expected to rise by 5.5% per year because of inflation. The firm's money cost of capital is 15%. Okay, so here what you have to understand is this, guys. There are two parts to it. Okay, and there is in the answer you can check, but find the NPV by discounting money cash flows. Find the NPV by discounting real cash flows. As I said, money cash flows takes into consideration inflation. Takes into consideration inflation. Remember, I told you, real return plus inflation is the money return. Takes into consideration inflation. And the real cash flows is the real return that you will get other than inflation. So the real cash flows does not take into consideration inflation. If you know this, so the money cash flows, as I mentioned just 2 minutes back, includes inflation. So real return plus inflation is the money return. And the real cash flows don't take into consideration inflation. We're simply talking about the original real raw return without inflation. If these two arrows are clean and clear for you, test your understanding 3 is over, you can say. Before I start, I will say it is over. Because if these two things are clear, then your logic is simple. What do I mean by that? I will Focus on the blue line. So this looks like a metro. It always reminds me of the metro, blue line, red line. So let's look at the blue line. Does not take into consideration inflation, right? And again, just look at the blue line. As per today's prices, the cash flow are 20,000 per year. So the real cash flows are 20,000. The real cash flows are how much? 20,000. Okay. So again, we haven't taken into consideration inflation because this is real return. So the second part, again, I'll do the second part first because that's going to be easier for you. But we're simply discounting the real cash flows, which is exactly what we did in the previous chapter. That should make it clear to you guys that in the previous chapter, whatever we were discounting real cash flows. That is cash flows without inflation. So what we will do is whatever I'm putting in blue, it's just a continuation of the previous class. Previous class as in what we saw earlier. Right? How much is the initial investment at time zero? The initial investment at time zero is 50,000. Again, we don't know what is the discount factor. We will calculate that later. But at time zero, the initial investment is 50,000. And from time 1 to 4, remember for 4 years, this is happening. You're getting 20,000 every year. So is this just a normal cash flow? Is this an annuity or is this a perpetuity? What is this? 20,000, is this an annuity? Is this a perpetuity or is it just a regular cash flow? Annuity. Very good. It is an annuity. So what we will do is year 1 to year 4, you're getting 20,000. So the cash flow is 20,000. Remember this, everything in blue is the real returns. We haven't taken into consideration what? Any inflation at all. So everything in blue, remember whatever is in the blue line, everything is real returns. Now we have to discount it. But remember this. The cost of capital is 15%. But the most important word you have to look at is it's the firm's money cost of capital. That is the cost of capital after taking into consideration inflation. And if you remember last chapter, we didn't look at money cost of capital. We just saw the raw, real cost of capital, not the money cost of capital. Did I ever say in the third chapter, oh, the money cost of capital is 18%? No, we never took into consideration inflation. But unfortunately, in this question, they have given you the money cost of capital. So that is the only challenge that is stopping you from doing this question. This part. You don't know what is the raw, real cost of capital. The problem is what? You don't know what is the real cost of capital. Why? Because the question has given you the money cost of capital. However, you can find it. How will you find it? This formula was there. Just use that formula to find the real cost of capital. Remember, 1 plus R is equal to 1 plus I divided by 1 plus H. Right? So again, I'm going to remove this. 1 plus R is equal to 1 plus I divided by 1 plus H. Right? And as per this question, according to this question, very good, Prachi, R is the real cost of capital. Yes, Arisha. See, R is what? R is the real cost of capital without taking into consideration inflation. It's the real rate, no inflation. We need R, right? So how will I get R? By this formula. 1 plus R is equal to 1 plus I. I is what? I is the money cost of capital, which is 15%. 15 divided by 100, which is 0.15. 1 plus 0.15 divided by 1 plus H. H is how much? H is the inflation. Very good, which is 5.5%, which is 0.55. You do this in your calculator. 5.5% is 5.5 divided by 100. 5.5 divided by 100 is 0.055. So 1 plus 0.055 will be 1.055. So 1 plus R is equal to 1.15 divided by 1.055. So how much is it? 1.15 divided by 1.15 divided by 1.055 is 1.09. So 1 plus R is equal to 1.0900. Therefore, R is equal to 1.0900 minus 1. So R is equal to 1.0900 minus 1 is equal to 0.09. Therefore, R is equal to 0.09 into 100 is 9%. So now we know that the real cost of capital is 9%. What will I do? Simply substitute it in this formula and just do it how we were doing in the previous class. Because remember, whatever is in blue, I said it is the real cash flows, which we can discount using the real cost of capital, just like how we did in the third chapter. I repeat, whatever I have put in blue on the right hand side of the screen, they are the real cash flows. So in order to discount them, you need the real cost of capital. The question had not given you the real cost of capital, but you use the formula to get the real cost of capital. Now that you have the real cost of capital, you simply discount using the same knowledge that I gave you in the third chapter, wherein you will simply open the discount factor table. Here it is, discount factor table, 9% for 1 year. Just move your hand across. It is 0.9174. But again, because this in this specific question is you don't need to do discount factor because it's an annuity. So you simply take the annuity factor table. Again, where is it? Annuity factor for 4 years is how much? 9% for 4 years. 1, 2, 3, 4 here. There's going to be the annuity factor is 3.240. So we got the annuity factor. So we just simply discount 3.240. And here remember, at time 0, right now, the value of 50,000, what is the value of that now? What is the present value of the 50,000? If you're investing 50,000 today, what is the value of that today? I mean, it sounds silly, but if you invest 50,000 today, the present value of that is 50,000 because you're doing it presently only. So the discount factor for time 0 is always 1. 50,000 will be multiplied with 1. There'll be no change. But the present value for period 1 to 4 will be how much? 20,000 into 3.240 is 64,800. Therefore, the NPV will be positive 14,800. Very good. Everybody is getting the answer. So the NPV is positive 14,800. So there is no problem in part B of the question. Part B of the question, as I said, real cash flow means there is no inflation taken into consideration. So I repeat, real cash flows are this without inflating the cash flows. In order to discount the real cash flows, you need the real cost of capital. We use the formula in order to get the real cost of capital. Once we got the real cost of capital, we'll just discount it as usual. Now we'll do part A of the question. This is the more trickier part. Here, they want you to discount the money cash flows. So they've given you the money cost of capital, but you have to find out the money cash flow. So the interesting part, there is an interesting part which I will come to. But remember, they want you to discount the money cash flows. This 20,000 is not the money cash flow. It was the real cash flow. You will get the money cash flow only when you inflate. Because remember, I told you money cash flow includes inflation. You understand? So what you have to do is 20,000 you will get in the first year. At time 1, you will get 20,000. But because you're getting this after 1 year, there will be an inflation. There will be a rise of 5.5%. So it will be 20,000 into 1 plus 5.5%, which is 1.055%. So after 1 year, the value of this 20,000, the money cash flow will be, again, we're taking into inflation. Yes, Nitish, you're right. So 20,000 into, why are we doing 20,000 into 1.055 is 20,000 is the real cash flow. We need the cash flow after taking into consideration inflation. And this 5% is the inflation that has been adjusted here. So if you inflate 20,000 at 5%, it will be 20,000 into 1.055, which is 21,100. So the inflated cash flow after 1 year is 21,100. So that is the money cash flow after 1 year. Similarly, you have to find the money cash flow after 2 years, 3 years, and 4 years. It is 21,100, but that will again inflate. So 21,100 into 1.055 will be 22,260.5. I got. Then again, that amount will further inflate in the third year. 22,260.5 will again inflate by 5% after 3 years. So again, you multiply into 1.055, which is 23,848. Sorry, 23,484.8. Then again, that figure you will inflate for the fourth time. 23,484.8 again is multiplied. We are again inflating it. Okay, into 1.055 will be 24,776.49. Very good, Osama. So it is 24,776.5. Now what I have here is, guys, my money cash flows. Now that I have my money cash flows, I can discount these using the money cost of capital. You understand? I will discount this using money cost of capital. I will explain this with a better example, but the money cost of capital will be 15%. So discount each of these cash flows at 15%. 15% for 1 year, 15% for 2 years, 15% for 3 years. Again, you have to open the discount factor table here. As you can see, my discount factor table, 15% for 1 year is 0.8696. So we are discounting it. 0.8696. So 21,000 into 0.8696 will be 15% for each of the years. Yes. So 0.8696. Then 0.7561 second year. Like this, you will find for all the years. Then third year is 0.6575. Fourth year will be 0. I'm getting the answers fast. That is good. Fourth year will be 0.5718. See my cursor, 0.5718. Fourth year. So you simply multiply and get the present value, 0.5718. So each of these figures, if you are going to discount, yes, that's right, Nitish. So each of these years, if you're going to discount, again, what will the present values be? 21,100 into 0.8696 will be 21,100 into 0.8696 is 18,348.56. Then 22,260.5 into 22,260.5 into 0.7561 is 16,831. Then 23,484 here. 23,484 into 0.6575 is 23,484.8 into 0.6575 is 15,441. Which is okay, 15,441. And 24,000 here, 24,776.5 into 0.5718 is 24,776.5 into 0.5718 is 14,167. So if you add up, also, sorry, I forgot, but times 0, how much is the outflow? The outflow is 50,000 and the present value of that will stay the same. So the total NPV will be 50,000 has gone out. What has come in? 18,349 plus 16,831 plus 15,441 plus 14,167 is 64,788. 64,788. So it is rounded off to 64,800. So again, the net present value is 64,800 minus 50,000 is 14,800. In both cases, in method A and method B, I got the same answer. In method B, I got 14,800, which is in blue. And in method A also, I got 14,800, which is in green. Now, guys, I will kind of simplify it for you even further. What do I mean by simplify it for you even further? Is test your understanding for yes, you will do on your own. But before we go to test your understanding for, you remember in school in grade 5, we used to do match the following. Let me do this here. Remember this basic maths match the following. How we used to do. See, 1, 2, 3, just follow my cursor. 1, 2, 3, 4, 5, 6, 7, 8. So this is 8 and it has to be properly matched with the number 8. Here we have 1, 2, 3, 4, 5, 6, 7, 8, 9. So where will you match it? You will match it with 9. A little more advanced version of this is what we have done basically. Little, it's not too advanced, it's just a little more advanced version of what we have done here. This, if you understood, this match the following if you have understood. Again, one more we'll do. 1, 2, 3, 4, this is 7, 5, 6, 7. So you match it properly with 7. If you have understood this, then what we are doing today and what we have already solved will be very easy. Why do I say very easy? It is basically simple maths, match the following. What do I mean by simple match the following? The money cash flows need to be matched with the money cost of capital and discounted. Simple. And the real cash flows need to be matched with the real cost of capital and discounted. Simple. For example, in part B of the question, you had the real cash flows. In part B of the question, you had the real cash flows. Real cash flows was how much? 20,000. There was no inflation. 20,000 was the real cash flows, and we wanted to match it with the real cost of capital. What did we do? We used the money cost of capital, we used the formula, and we found out the real cost of capital. We got 9%. So in part B, the real cash flows were given. In part B, real cash flows were given. You had to find the real cost of capital and discount. And in part A, the money cash flows were not given. What was given? The money cost of capital was given. You had to find the money cash flows. The money cost of capital was given. you had to find the money cash flows and discount. So basically, simple match the following. Money cash flows need to be matched with money cost of capital and discounted. Real cash flows must be matched with real cost of capital and discounted. In part B, as I mentioned, cash flow was there. Cash flow was given 20,000 per year. It was there, it was mentioned. You had to find the real cost, you had to find the real cost of capital. But in part A, cost of capital was given. You had to find the cash flows. So it's the opposite. But if you've understood this, which I'm ticking, that's it. Test your understanding 3 is very easy for you. Okay. So test your understanding 3 is what we did today so far. Okay. Can we all boldly try test your understanding 4? It's the same logic, same kind of understanding. There's nothing at all that is new. Can we see if we're able to do it? A project has the following cash flows before allowing for depreciation. The company's money discount rate is 15. So it's literally the same thing. So here what has happened, they've given the money cash flows. I'm sorry. They've given this is before allowing for depreciation. So they've given the real cash flows. Discount it using the real rate. How will you find the real rate? Simply use this formula. 1 plus R is equal to 1 plus I divided by 1 plus H. So again, real cash flows just discount it using the real rate. And then they've given you the money cost of capital. Find the money cash flows and discount using the money cost of capital. I'm going to pause the recording and I'm going to give all of you like about 5 minutes so to try test your understanding 4. Let's resume. It has to be very simple. Test your understanding 4. I've got a few answers of few people. Arisha, the rate would not be 1%, it would be 10%. So probably 10 you missed. Okay, and the NPV for real is 330. Again, because of that calculation, I think you've lost. There's no point checking your answer. Okay, 2 rate is 10%. Okay. Nitesh, yes, Nitesh, that's 10% NPV. Nitesh, your answer is absolutely right. Kittu, 10%, 150. Kittu, your answer is also perfectly correct. Okay, I will start helping you out, which is the second thing that we're doing today. Test your understanding. 4. Okay, I'll do part A first. It says calculate the real cash flows. But again, real cash flows are given. Real cash flows are what? At time 0, there is an outflow of 750. And of course, the discount factor for time 0 is always 1. Remember this. So 1. Yes, Arisha, I understood that. Anytime there's a mistake like that, it's because of calculation, but then that will make your entire answer wrong. Okay. First year, we're getting 330. I don't know what the discount factor is. Second year, I'm getting 242. Third year, I'm getting 532. Remember now, these are the cash flows without adjusting for inflation. So they are the real cash flows. But I need the real discount rate. And the formula, which formula will I use? Go back. This formula I will use. 1 plus I is equal to 1 plus R divided by 1 plus H. And if you just do simple math, the formula can be rearranged where, again, this 1 plus H will move to the left-hand side. And when that happens, it will become 1 plus R is equal to 1 plus I divided by 1 plus H. So I got the formula from the beginning of the chapter. And what do we have to know? I is how much? I is the money rate and H is the inflation. So 1 plus R is equal to 1 plus I. I is the money rate, which is 15.5%. 15.5% means 15.5 divided by 100, which is 0.155. So 1 plus 0.155 will be 1.155 divided by 1 plus H. H is what? H is the inflation, which is 5%.
It's 3 o'clock.
So 1 plus 5% is 1.05. Okay, so 1 plus R is equal to there's going to be 1 plus R is equal to 1.1. So R is equal to 1.1 minus 1 is equal to 0.1. 0.1 as a percentage, you have to multiply with 100. So 0.1 into 100 is 10%. So we've got the real discount rate. The real discount rate is 10%. So simply substitute that here. You have to find the discount factor using the real discount rate. Right? And again, if you take 10% for 1 year is 0.9091. Here, these are your rates. First year is 0.9091. Just check if you all got this correct answer. 9091. Second year was what? $0.8264. Third year was what? 0.7513. Now, simply multiply in order to get the present values using the real rates. 0.909, 0.8264, 0.7513. Again, what will you get? You will get 330 into 0.9091 is 300. 242 into 0.8264 is 199.99, which can be taken as 200. And 500 into 0.7513 will be, 532 into 0.7513 will be 399.69, which can be taken as 400. So 400 plus 200 is 600, 600 plus 300 is 700. So the NPV will be, 300 plus 200, 500, 500 plus 400, 900. 900 minus 750, there's a positive NPV of 150. This is using the real rates, real cash flow, real discount rate. So part A of the question is over. Part B of the question, I'll not calculate. Most of you have got the answer. But in part B, the discount rate is given. The money discount rate is given. You have to basically, these cash flows, you have to inflate based on the inflation and get the money cash flows. So in part A, the real cash flows were given. You had to calculate the real discount rate. In part B, the money discount rate is given. You have to calculate the money cash flows. So I hope with that, test your understanding 4 is clear. Okay. And I hope with that, this fourth chapter is very simple, very easy. There's no problem at all. Now, what is the next thing that we do? Now, again, there is an element of specific and general inflation rates. This is something very, very simple. People unnecessarily complicate it. What does this mean? We will look at all this, inflate, deflate. No need to panic at all. We'll simply look at test your understanding 5, and that should make life easy for you. A company is considering a cost saving project. This involves purchasing a machine costing 7,000, which will result in annual savings on wage costs of 1,000 and on material costs of 400. Okay. The following forecasts are made of the rates of inflation each year for the next 5 years. Here, there is a little bit of a trick. And the trick is, in the previous question, until the previous question, there was only one rate of inflation. There was a general rate of inflation given. But now there is a general rate, yes. But in addition to that, there is also a specific rate or a rate that is specific. There is also a rate of inflation specific to each expense. What do I mean by that? See, there is no doubt that there is a general overall inflation, no doubt, 6%. But there is also a rate of inflation for each expense. For example, wages are inflating by 10% every year, specific to wages. Material cost is inflating by 5% every year. So that is what the textbook is trying to say. There is a general rate of inflation, but also there is a specific inflation rate. So again, we will understand this best by doing test your understanding 5. Here, what's happening? Here, let's look at this. Assuming that the machine has a life of 5 years and no scrap value. Right now, so we will tabulate this way. T0 is when we are investing, which is right now. Okay, we are investing 7,000, so 7,000 is going out. Now, because this is a little lengthy, I'm tabulating it like this. T1 T2, and there are 5 years. So T3, T4, T5. T3, T4, T5. Now, what is happening? We know there are 5 years. We know in the first period there was an investment outflow of 7,000. Correct. But why I've put it separately like this is because each item, for example, wages, is inflating at 10%. So, see, wages are 1,000, but there'll be a 10% increase in that. So, it will be 1,000 into 1.1. 1.1. Why? Because there's a 10% raise, 10 divided by 100, 10% raise. So 1000 into 1.1 will be 1100. As of now, just forget that this is a separate wage inflation. Just inflate normally how we did in the previous two questions. Then again, 1100 will again inflate at 10%. So 1100 into 1.1 is 1210. Then again, 1210 will again inflate at 10%. So it will be 1331. Then again, that will inflate at 10%. So 1331 into 1.1 will be 1461.1. Then again, that will inflate at 10%. So 1461.1 into 1.1 is 1610. So these are the inflated figures. Don't worry about labor, completely ignore it. For now, you just need to know that there is wages which was inflating at 10%. Wages was 1,000 and every year we inflated at 10%. So 10% means 1 plus 10%. 10 divided by 100 is 0.1. So that's why it is whatever the number is into 1 plus 0.1, which is 1. So 1000 was multiplied with 1.1 to get 1100. Then again, that 1000 is inflated at 1.1. 1100 into 1. So we got 1210. Then again, that 1210 was inflated at 1.1. Why? Because of 10%. Then again, that 1331 was again inflated at 1.1. Then again, that is inflated at 1 point. That is what has happened here. Once you've understood that, you can do material on your own. Material was how much? 400. But every year it is inflating by 5%. So think about it, 400 into 1 plus 5%. 5%, do it on your calculator. 5 per 100. 5 divided by 100 is 0.05. So it will be 400 into 1 plus 0.05, which is 400 into 1.05. Again, 400 into 1.05. After 1 year, it will be inflated at 400 into 1.05 will be 420. Again, you inflate that at 1.05. 420 into 1.05 will be 441. 441 into 1.05 will be 463.05. 463.05 will again be inflated at 1.05. 486.20 something. So just take it as 486. Then again, that is inflated at 5%. So 486 into 1.05 is 510.5. We can just remove these points. That calculation will be easier. Right? How did we get each of this? See, we knew that material was 400. The question is telling you. So for the first year, if you're inflating it at 5%, 400 into 1.05. So 400 into 1.05, if you do it, after 1 year, you get the value of 420. That 420 again is inflated by multiplying with 1.05 and so on each year. It is all multiplied with 1.05 year after year. Okay. Now I know the calculations are heavy. This chapter is very calculation heavy, but it's very easy. Common sense wise, it's very easy. There's not much to kind of grasp. So the net cash flows are going to be how much? Think about it. 7,000 has gone out. 41, how much is the total? 1,100 plus 420 will be 1,520. 42, 1,210 plus 441. CT2 will be 1,651. 43, it will be 1,331 plus 463 is 1,794. T4 and T5, just calculate and tell me the totals. Quickly, let's see who gives me the answer fastest. And T5, again, 1650 plus 510. 1610 plus 510 is 2120. Don't worry about general prices right now. Just know that this is what we're doing. So we have the net cash flows. Okay. We have it, it's there. We have, what have we done? All of these cash flows have taken into consideration the specific inflation rates. Okay, we have taken into consideration the inflation rates, and the rate the textbook has given you is the real rate. So again, you have to use the formula to get the money rate. What was the formula? The formula was again 1 plus I is equal to 1 plus R into 1 plus H. Correct? Now what you is 1 plus I, you don't know what is I. So let it be 1 plus I is equal to 1 plus R. What is R? R is the real rate, 8.5. 8.5% is 8.5 divided by 100 is 0.085. Into H, which is the inflation rate. Now you will use the general inflation rate. You obviously cannot use the specific interest rates, inflation rates. You have to use the general inflation rate. So now when you calculate the value of the money rate in this formula for this H, you will use the general inflation, which is how much? 6%. 1 plus 6% is 6 divided by 100, which is 0.06. Therefore, 1 plus I is equal to, simplify it further now, 1 plus 0.085 will be 1 plus 0.06 will be 1.06. And 1.06 into 1.085 is 1.150. So 1 plus I is equal to 1.150. So I is equal to 1.1501 minus 1 is equal to I is equal to 0.15. Into 100, if we take it as a percentage, I is equal to 15%. Now that you know this, we can simply continue to discount these cash flows at 15%. Will be discounted at 15% as usual. What do we mean by as usual? Again, open your discount factor table for 15%. First year is 0.8696, which can be taken as 0.870. So discount this 1000. So remember, 7,000 is at time 0. So the discount factor of that for that is 1. But this 1520 is for time 1, and the discount factor can be taken as 0.870. For T2, again, what is the percentage we're taking? 15%. For T2, it is 15 into 2 years, 0.7561. Here, 0.7561. So, continue and get all the discount rates from this table. 0.6575, 0.5718, 0.497. You take all these discount rates for third year, fourth year, and fifth year. 658, 0.572. We're just rounding it off. 0.4971. So once you have these figures, cash flows, this is after taking into inflation. So this is the money cash flows. And this is what this discount factor has been used. We got this discount factor by using the money rate. So now we can directly discount. Remember, this is the money cash flows. And this discount factor we got using the money rate. So we can now discount. So obviously 7,000 into 1 is 7,000. 1520 into 0.870 is 1332.4. 1332. Again, 1651 into 0.756 will be 1248. 1794, you have to just take this. 1794 into 0.658 will be 1180. Then again, 1947 into 0.572. 1113. 1113.68. So you can round it off to 1115. And then you have 2120 into 0.497. So what will be the present value? Is 105, 1053. So 1053.64. So you round it up to 1054. So we have the present values. So you just have to calculate the net present value. What will be the net present value? 7,000, negative 7,000 plus 1332 plus 1248 plus 1180 plus 115 plus 1054. How much? 1332 plus 1248 plus 1180 plus 1115 plus 1054, which is 5,929. So think about it, one negative figure, one positive figure, negative plus positive. Again, you have to take the difference. Simple maths. So it's minus 1071. The present value is minus 1071. So it is a negative NPV project. So it is not worth doing. This is test your understanding 5, guys. How and what did we do? We will come back from the break and discuss. I mean, summarize, right? So it's what's the time? 3:25. So till 3:35, you take your break and come back by 3:35. Thank you. Yes, guys, welcome back. It's 3:35 p.m. So we know that we start sharp at 3:35. Yes, Kitu, tell me, you wanted to say something. You were trying to say something before the break. Okay. So any questions, Kitu? You want to see the calculations or it's fine? So class is still 4:30. Okay, the reason is, again, we were told that if we can reduce like 30 minutes, people are more comfortable for like 2.5 hours than 3 hours. So we'll wind up by 4:30. So 4:20, I will stop and give you time to review. So it's just about another 45 minutes and then you can go. But for whatever reason, there's a big problem with my device charging. Give me 1 second. Yes, FM does have working professionals. All the batches have working professionals. Okay, now there is a loose connection. Okay, so hopefully this should be fine. Now, with that, we've done test your understanding 5. The next thing we're going to look at is very, very interesting. And again, I don't believe in like reading, making you mug up. So I think I will directly move to test your understanding 6 and I'll explain what we're doing. And then based on that, your understanding will be very simple. And once that is over with test your understanding 6 and 7, the chapter is over. So again, today is the 5th class. 1, 2, 3, 4. Yeah, today is the 5th class. So ideally, I would want to be like in the 5th chapter today, which again, next chapter is on what? Decisions and capital rationing. So at least, if not teach you this chapter, at least like introduce you to this. That's the objective. That's the idea. And again, it's a very easy chapter. Okay, you have something known as EAC and all that. So by Friday, I'll complete the fifth chapter. And also, guys, the textbook and the Kaplan kit has been already uploaded on the LMS. So in order to make your life easy, it shouldn't be like I'm teaching you from one book, you're studying from PPP. So it should not be like that. So we've shared the Kaplan kit on the LMS. Okay, test your understandings. An asset is bought for $10,000 and will be used on a project for 4 years, after which it will be disposed of. Tax is payable at 30%, 1 year in arrears, and tax allowable depreciation is available at 25%, reducing balance. Look at part A of the question. Calculate the tax allowable depreciation and hence the tax savings for each year if the proceeds on disposal of the asset are $2,500. So in this case, what do you do? Again, it's very simple and it's very easy. All you have to be clear with and comfortable with is the logic, which I'll explain. See, how much is the initial investment? 10,000. Okay. Duration is 4 years. Okay. Now, the new part in this question and in these topics are what the latest, newest part is tax. Meaning, whatever we earn, guys, the government wants a percentage out of it. The government wants us to give them some money. The government wants what? The government wants us to pay them. Right? So, whatever we earn, suppose for example, it's just an example. Okay, don't look at part C. But in part C, we have an income of 8,000 every year. From that 8,000, yes, we will get that 8,000, but a little bit we will have to give it to who? To the government. How much is that little bit? It is 30%. So that is what we mean by tax is payable at 30%. Now, this itself is a very interesting topic because it is very interesting, very easy. Right? So whoever wants to do tax, we will be doing this shortly in the next paper, tax paper. How many of you have completed tax? Or Arisha has completed. So it's a very, very interesting paper. Oh, only FM is remaining. After that, you move to P levels. Yes, tax is very easy. So what is happening with respect to the tax? We will pay 30%. And there is something known as tax allowable depreciation. What do I mean by tax allowable depreciation? I simply mean that, remember, you need to know that depreciation is an expense. Depreciation we've seen in the beginning of FM, and we look at this in a lot of detail in FR. Who is yet to do FR? Okay, Osama doesn't have to do FR. How many of you are yet to do FR? You still have to do it. FR paper, Anjana is yet to do, Arisha is yet to do. So we've seen this in the FR paper that when you have an asset, forget an asset, just imagine a shoe. You bought the shoe for 2000 rupees. Okay. You use the shoe for 1 day, 2 days, 3 days. Will the value be the same after using it for 6 months also? Will it still be worth 2000? Will it still have a value of 2000? Very good, Kitu. No, there will be a drop in the value. This drop in the value of the shoe because of wear and tear. Like you'll wear the shoe will get a little worn out, a little bit the back side, the heel side of it. Because of wearing it, it will get a little pressed. This drop in the value of an asset due to wear and tear is known as depreciation. So again, shoe isn't really the best example. I just gave it so you can imagine. But the drop in the value of an asset due to wear and tear is depreciation. So instead of saying drop in the value of the asset, drop in the value of the asset, we will just say one word. What is that? Depreciation. Now, depreciation is the drop in the value. So it's something that is costing us. It's a bad news for us. Our asset is dropping in value. It's a bad news. It's an expense. It's a drop in the value. It's a bad news. It's an expense. Therefore, what is happening is there will be no tax charged on this because you are sad. You know, sometimes when you are sad, remember, go back to your childhood. You are sad. So when you are sad, to make you a little happy, an elder will come and say, oh, okay, no problem. You don't need to do your homework today. We will go out. So something like that. Because it's an expense, you don't need to pay tax on that. So you save taxes there. Whenever there's a depreciation, yes, there is a drop in the value. But the good thing is, you don't need to pay tax on the drop in the value. So there is a bad news, you are sad, but you don't need to pay taxes on that. So there is a tax saving. Okay, so this is the brief introduction to this question. We will look at this question in a lot of detail now. How? What are we going to do? Remember this. When we bought it at time 0, the asset had a value of 10,000. But then what happened after 1 year? There was wear and tear. For 1 year, you were using it. Imagine a mobile. You use it on the first day, it will be brand new. It will be very shiny. It will be very nice. There will be not a single scratch. So it will have the full value of 10,000. But after 1 year, there will be some scratches. Maybe it will be a little slow. So there is a drop in the value of the asset due to wear and tear. So there was after 1 year a depreciation. During this year, there was depreciation. So after 1 year, the value will drop. Why? Because during the year, there was depreciation or drop in the value of the asset due to wear and tear. And the question clearly says that the depreciation is 25%. Every year, there will be a drop of 25%. So 25% of 10,000 is 2,500. So there will be a depreciation. Depreciation I'm putting in red because it's an expense. So now the asset after 1 year will only have a value of the remaining 7,000 500. Guys, is this much clear to everyone?
Yes, sir.
Was the value, but there was a depreciation of 25%. There was a drop in the value. So from 10,000, if the value has dropped by 2,500, the new value will be 7,500. So here you are sad, right? You are a little sad because your asset has depreciated. You are sad. So wherever you are sad, the government is coming and telling you, okay, you lost 2,500. But they are coming and telling you, oh, but if you did not lose it, you would have to pay tax on that 2,500. But now, because you have lost it, you don't need to pay a tax of 30%. You don't need to pay a tax of 30% on this 2,500. So they're trying to make you a little happy. So you're saving, you don't need to pay tax on that 2,500 because you lost that 2,500. It's not there with you. So the tax saving will be 30% of 2,500. How much is 30% of 2,500? 250, 500, I think it's 750. The tax saving is 30% of 2,500, which is 750. Why is this a saving? Now, again, this is a good thing for you. So I'm putting it in blue. Why is this a saving? Because you have lost 2,500. So you don't have that 2,500. So you don't need to pay tax of 30% on that. So it's a saving. Like that, we will continue for each of the other years. Again, in the second year also, there will be wear and tear of the asset, 25% of 7,500. So how much is 25%? See here, the depreciation is 25%. So 25% of 7,500 is 1875. So there is again a depreciation of 1875. Again, you are sad. Again, you are losing. But again, your government is coming and saying, don't be sad. You are saving taxes. Because you have lost 1875, you don't need to pay 30% on that 1875. Kitu, yes, it's calculated on the you don't need to make your life so complicated. Tax saving is to be calculated on the depreciated amount. Well, again, think about it. This money is lost. 2,500 is lost. So obviously you don't need to pay tax on that because it's gone from your hand. It's not there. So you don't need to pay tax on that. So in order to answer your question in one word, yes, tax saving is to be calculated on the depreciated amount. But why? Because that depreciated amount is lost. You don't need to pay tax on that. So again, this 1875, it's lost. You are sad that it's gone from you. But the good news is on that 1875, you don't need to pay tax. Tax is 30%, but now you don't need to pay 30%. So 30% of 562.5 is like a tax saving. Similarly, you will do for year 3 and year. How many years are there? 4 years, correct? 4 years. So again, what will happen? Think about it. From 7,500, if 1875 was depreciated, by the end of the second year, or sorry, by the second year, the value of the asset is 7,500, but there was a drop in the value by 1875. So 7,500 minus 1875 is 5,625. Very good, Kittu. Again, there will be a depreciation on that. How much is the depreciation? 25%. 25% of 5,625 is how much? 25% of 5625 is, there is a depreciation of 1406.2. But again, you are unhappy, you are losing money. See, you have lost money, so you are not happy. But again, who is coming? The government is coming and say, hey, see, don't need to pay tax on that 1460. 30% tax which you would have paid normally. Now, because that 1460 is lost, you don't need to pay it. So you are saving how much? 421.8, which can be rounded off to 422. Okay, I hope you all are understanding this. It's very clear. Then finally, what is happening in T3? T3 is time 3. You have 5625 minus 1406, which is 4219. So again, there will be a depreciation on that. Again, how much is it? Depreciation is 25%. 25% of 4219. Now again, guys, it's very easy. It's just that it's repeated calculations.
One zero five four point seven
1054.75.
54.75.
But what is happening in this case is an asset is bought and will be used in a project for 4 years, after which it is disposed of. So what is happening? First year depreciation, okay, for that is for time 0, there was a depreciation. Sorry, for the first year, there was a depreciation of 2,500. Second year, third year, but in the fourth year, we are selling off the asset. So here we will not depreciate, because in the fourth year, you are selling the asset. So there's no wear and tear. You are ready to pack it up and sell it. Yes, Arisha, that's right. Fourth year, it's like you are ready to sell it. So you're packing the asset, putting it in the box. So you're not using it. So there's no wear and tear. What is happening in the fourth year is there is a sale. You sold the asset. And again, I'm putting this in blue because you're getting money. How much is the sale? You sell it for 2,500. Now tell me one thing. The asset had a value of 4219. But how much did you sell it for? Only 2,500. Are you happy or sad? Your mobile had a value of 4,219, but the customer has only paid you 2,500. Are you happy or sad? Nitesh, are you happy? Think your mobile has a value of 4,219. So you are sad. Again, you are sitting sad. Why? Because you have kind of lost how much? 4,219 was the value, but you only got 2,500. So it's like you have lost 1719. You understand? So you call this loss the balancing allowance. So you have lost 1719. So again, you are sad. And again, when you are sad, who is coming? The government. And what is the government saying? Hey, you have lost money. Don't be sad. You don't need to pay taxes on that. So you will save 30% tax. So 30% of 1719 is 515. 516 you can take it as. So these are all your tax savings. Yes, 515.63, but you can round it off to 516. Okay, so calculate the tax allowable depreciation First part of the question. And hence the tax savings for each year if the proceeds on disposal of the assets are 2,500. So we have done part A of the question. This is part A. Part A is done. Now we'll do part B. How would your answer change if the asset was sold for 5,000? Nothing. There would be no major change. The only difference is here. All of you look at the screen. Here, instead of being sold for
It's 4 o'clock.
What would you do if you are selling the asset not for 2,500 but for 5,000? What would be the difference? Is this everything else would be the same till this part, copy and paste. I have copy and pasted it. See, everything else is the same. The only difference is till here it is same, but the only difference is in part B, when you're selling for 5,000. So are you happy or sad? You have an asset with a value of 4,200, but the customer is paying you 5,000. Will you be happy or sad? Nitish is happy. Janvi is happy. Jigyasa is happy. Everybody is happy. So it's something where now the government will come and say, oh, you are happy. They will charge you for that profit. See, you have a profit of 5,000 minus 4,290. So you have a profit of 781. Right? 781 is like a profit. What you call it, you will not call it balancing allowance, you will call it a balancing charge. The balancing charge is 781 profit. And now the government is coming and saying, oh, you are happy, you got 781. So you have to give the government 30%. So it's not a tax saving, it's a tax payable. 30% you have to give to the government. 30% of 781 is, okay, I'll not say tax payable because again, we've done this in the tax papers, tax payable, tax liability. So anyway, it's okay. 781 into 30%. So you paid 234. That is the tax that you have to pay. Tax paid would be 234. So I hope all of you are clear with part A and part B of this question. Okay. The next part is part C. If net trading income for the project is 8,000 per year, based on your answer to part A and cost of capital of 10%, calculate NPV. So now it's very easy. It's just what we did in the previous chapter, but with a little more information. So the information would be, again, T0. Again, I'm computing it like this because there's a lot to kind of do. Okay, just compute it. So you guys, you have T0, T1, T2, T3, T4, T5. Okay, so these people are there, right? Now what happens? Again, we need to see what is coming in. Every year, 8,000 is coming in. right? It will come from the first year onwards. So as usual, 10,000 is being invested now, just like the previous chapter. We're investing 10,000 now. First year, we're getting 8,000. Second year, we're getting 8,000. So it's actually like an annuity. But the reason we cannot do the annuity factor here is because there are other cash flows also coming in each of the other years. Okay, so 10,000 is going out, 8,000 is coming in. Okay, now the problem is, now the thing is, 8,000 is an income. And on that income, there is a tax of 30%. So, what does the question say? Tax is payable at 30% 1 year in arrear. Arrear means in delay. 1 year in arrear. Arrear means what? Delay. So, in this case, what happens? First year's tax I will pay in the second year. I'll not pay in the first year. 30% of 8,000 is how much, guys? 800 into 3 is 2,400. So 2,400 I have to pay in the first year, but you will not pay in the first year. For the first year, you will pay in the second year. So cash is going out in the second year. For the second year, you will pay in the third year. You have to pay tax. For the third year, you will pay in the, oops, sorry, T2, T3. Then T4, T5. For the third year, you will pay in the fourth year. For the fourth year, you will pay 1 year in arrear means 1 year after. And for the fifth year, you will pay in the sixth year. Are you understanding? First year, second year paid, second year, third year paid, third year, fourth year paid, fourth year is fifth year paid. And remember, sorry, there are only 4 years. So for the fourth year, we're paying in the fifth year. So I hope this is clear, guys. See, in the first, at time 0, we're investing 10,000. That's clear to everyone. Then there are 4 years in which there is income, T1, T2, T3, T4. 8,000, 8,000, 8,000, 8,000 each. Tax needs to be paid 30%, 1 year in arrears. So first year tax is paid in the second year tax is paid in the third year tax is paid in the fourth year tax is paid in the fifth year. All of you comfortable with this much? In the fourth year, we will sell the asset. See, at the end of the fourth year, we're selling the asset for 2,500. So in the fourth year, we will also receive money by selling the asset. How much are we receiving? We're receiving 2,500. Okay. And because we have this asset, in each of the years, we will get a tax saving. See, here we had calculated. For the first year, we have a tax saving of 750. So for the first year, we will pay the tax in second year. So when we are going to pay this 2,400, it's like you pay 2,400, but the government will say return back 750 to you because there is a tax saving in the first year of 750. So when you're going and paying for the first year tax, you will pay it in the second year. When you go in the second year and pay for the first year, you go to pay 2,500, but the government returns 750 to you. It's like you get it back. It's like a saving. And accordingly, second year, there was a saving of 562.5, which you will get back in the third year. So again, I'm not subtracting because it's a saving. It's like you're getting it back. So I'm adding it. 422. It's a third year saving, but you'll get it back in the fourth year because all the taxes are paid in arrears. Are you understanding? And in the fifth year, what is happening? Remember this, there was a tax saving of 516 because of this balancing allowance. So in the fifth year, for the fourth year, there was a balancing allowance and there was a saving of 516, which you will get back in the fifth year. So based on these figures, you calculate the net cash flows. 10,000. First year is 8,000. Second year will be 8,000 minus 2,400 plus 750. How much is it? 8,000 minus 2,400 plus 750. How much is it? 6,350. What about the third year? 8,000 minus 2,400 plus 562.5, which is 6,162.5. Similarly, do it for all the years. T4, 8,000 minus 2,400 plus 2,500 plus 422 is 8,522. And in the fourth year, how much? There is a negative cash outflow. 2,400 is gone out. 516 you get. So there is a negative outflow of 2,400. There's a negative outflow of 1,884. Now that you have the net cash flows, as usual, you will discount. There is nothing new now. The remaining part is as usual, you will discount. For T1, the discount factor is 1. So the present value will be negative 10,000. This is for T0, I'm sorry, not T1. T0, the discount factor is 1 itself. So 10,000 into 1 is 10,000. And for T1, again, 10%, you use the discount factor table. 10% for 1 year is how much? 0.9091. You will take these discount factors. First year is 0.9091. 0.9091. Second year, now it's just as usual, 0.826. Third year is 0.751. Fourth year is 0.683. Fourth year is 0.621. Fifth year is 0.621. So again, multiply each of these cash flows with the discount factors to get the present value. Please tell me finally what is the NPV? Nitesh, your answer is right. But I want everybody, let's see if there's any problem. Let me know. Quickly, guys, everyone do the calculation. Be active. Guys, by Friday, I want to be in the 6th chapter. by May 10th, I want the syllabus to be complete. So that is what we've done. Okay. So today, the 2nd of April, again, we've only looked at, now again, because nowadays, as in when we're doing the topics, we're doing like bigger topics. So obviously, like we've done technically just 4 questions today. Okay. Now we're going to look at working capital. First of all, what is working capital? This is the money that you need to run the business. And the working capital formula is current assets minus current liabilities. Again, don't worry too much about it, but the working capital is basically the capital that you need to run the business, to work, to pay off your liabilities. Okay, and also we will look at the last part of this chapter, which again I'm not doing now, but you're getting 11,509. Could be because you've used too many, like you've left a lot of decimals. So it could be because of that. So there's a difference of 300, or because you've made some calculation mistake in any of the years, or because you've used the wrong discount factor. Could be either of these three. Okay, so what is working capital? Working capital is the capital, the money that you need to run the business, right? And it is current assets minus the current liabilities. In the next class, which is on Friday, before moving to the 5th chapter, Friday is unfortunately our 6th class, and we should have been in the 6th chapter because these are all easy chapters, small chapters, easy chapters. So, I mean, it just made sense to be in the 6th chapter by Friday, but unfortunately, we will only be in the 5th chapter. So, Friday, I will go a little faster. And I can because the next chapter, which is the 5th chapter, is a reasonably easy chapter. Right? By next week, syllabus finish. I don't know how is that possible. T2. I don't know if this was a joke or what, but Friday we'll finish. This Friday we'll finish up to 6 chapters. How? No, it's definitely not possible. How come we finish the syllabus by next week? We will finish 6 chapters by this Friday, and by next Friday, maybe another, say, 3 chapters. So half of the syllabus we can complete by next week. Anyway, it's 4:20. So just go through these things that we've done today and go through it carefully, see all these questions, and let me know if there's any problems. FM. Yashika, we have uploaded the exam kit. Exam kit is already uploaded. Just check your LMS. Titu, can you explain the match the following shortcut? That match the following was simply done over here. Right? What do I mean by match the following is when the cash flows are given, these cash flows are there. Okay, let me take an easier question. Chapter 5 and 6, you are always stuck. So yeah, 5 and 6 we're doing in this coming week, Friday and the week after that. So don't worry about it. Where did that go? Here. So shortcut Kittu, what is the shortcut? Shortcut is simply saying that whenever real cash flows are given, simply use the real rate. And when money cash flows are given, match it to the money rate. For example, here in this question, this is the real cash flows. But in order to discount using real rate. In order to discount it, you need the real rate, which you don't have. You have to calculate it using the formula. And if you want the money cash flows, you have to discount using the money rate. Here, money rate is not given in this question. It's not there. So you have to get the money rate by inflating each of these figures. Once you get the money rate, you can discount it using the money discount rate. Kittu, clear? Yes, guys. So you can rate your understanding out of 5 and leave. Thank you, Kittu. 5-star. Everybody else? Osama is 4.8. Osama, why are you 4.8? You want to go faster? Is that what you're saying? Okay, fine. All right, guys. So we will catch up on Friday and we will complete the 4th chapter and move on to the 5th chapter. Okay. Thank you so much, guys. See you. Bye.